Maya, Jordan, and Ben each dropped $10,000 into the market on the exact same afternoon. Same brokerage app, same shaky thumb hovering over the same green button. One is chasing tomorrow, one is buying the whole board, and one is simply collecting today's cash. And here's the part that should unsettle you. The outcome won't be decided by any of that at all. It comes down to which one of these three loses their nerve, because two of them are walking straight into a mistake they won't even notice for years. The costliest errors in investing never sting on day one. They show up quietly in year 11, right after you've spent months bragging to everyone who'll listen about how brilliantly things are going. I'm Nathan, and I've spent way too much of my life finishing the math that finance channels start and then quietly drop before the thumbnail's promise gets tested. If you've ever had three friends each insist a different fund is the only one worth your money, and you had no idea who was actually right, stick around, because today we're settling it with real numbers instead of gut feelings. Let's be straight about the setup. Maya, Jordan, and Ben are the same age. They make the same paycheck. They opened identical accounts on the same day. No inheritance, no rich relative, no lucky windfall bailing anyone out. The only difference is which three-letter ticker each of them searched for. And hold on to this thought as we go, because there was a fourth option sitting right there on the same screen the whole time, the one this entire video is really about, and not one of the three of them chose it. So let's introduce the funds, because the whole story is hiding in the details nobody bothers to read. Maya picked VOO, Vanguard's version of the S&P 500, a basket holding roughly 500 of the biggest companies in the country. The fee is a razor-thin 0.03% a year, meaning on 10 grand she pays about $3, not per month, per year. It's so cheap and so widely held that it recently became the first fund ever to blow past $1 trillion in size. Maya now owns a tiny slice of essentially the entire US economy, and it cost her less than a cup of coffee. Think of Maya as the market. Jordan bought QQQ, tracking the NASDAQ 100, about 100 companies leaning heavily into technology names like NVIDIA, Apple, Microsoft, Broadcom, and Amazon. Jordan isn't really holding a spread-out fund so much as a very strong opinion about artificial intelligence dressed up as a ticker. The cost is 0.18%, 6 times what Maya pays. Over the past decade, that fund turned $10,000 into almost $72,000. Jordan knows that number by heart and will absolutely bring it up. Think of Jordan as the bet. Ben went with SCHD, a dividend-focused fund holding about 100 fairly unglamorous companies that have paid shareholders every year for at least a decade straight. Banks, manufacturers, the company behind your toothpaste. It hands him roughly 3.3% a year in real cash, close to triple what the S&P typically yields. So, on day one, Ben's big exciting payoff is about $330 in dividends, showing up like a card from a distant aunt. Modest, reliable, and a little underwhelming. Think of Ben as the paycheck. For the first year, none of this feels like a contest, and it definitely doesn't look like Ben is ahead in any way. Jordan checks the NASDAQ the way some people check their horoscope, and for a while, fortune is generous. Jordan's 10,000 climbs, dips, then climbs even higher. At every dinner with friends, Jordan has a story, a screenshot, that unmistakable energy of someone who's mistaken a bull run for a personality. Maya barely has anything to say. Her fund did roughly what the entire market did, which is exactly the point, but it makes for dull conversation. She has a confirmation email and a quiet sense of being the responsible one. Ben has the least thrilling position at the table by far. His $300 in dividends lands, gets reinvested automatically, and impresses absolutely nobody. Let's be honest, no one has ever walked into a party bragging about their dividend yield and been met with genuine excitement. So after year one, the emotional scoreboard is obvious. The bet is winning, the market is fine, the paycheck is fast asleep. But the emotional scoreboard and the real scoreboard are two completely different things, and over the next 10 years they start disagreeing sharply. Let's jump ahead to year 3 and get real numbers on the table, and I have to be upfront about the assumptions here because this is exactly where most videos quietly start misleading you. Nobody actually knows what any fund will return going forward, so instead of pretending otherwise, I'll use conservative long-term averages and call them out clearly as illustrations, not guarantees. Say Maya's market fund averages roughly 10% a year, close to its historical norm. Say Jordan's tech bet runs hotter around 12%, which matches its history while being a far bumpier ride. And say Ben's dividend fund lands near 9% total once you factor in reinvested payouts. At those rates, 3 years in, the market sits around $13,300, the bet is near $14,000, and the paycheck is around $12,900. Jordan is ahead, visibly and smugly ahead. If the story stopped right here, the thumbnail would practically write itself. Tech wins, buy the NASDAQ, subscribe for more. But 3 years is barely anything. It's the opening scene before the actual plot arrives. And the thing that decides who really wins hasn't shown up yet. When it does, it won't knock first. It'll just walk in and flip the whole table over. Here's the number that trips people up. Over the last decade, Jordan's bet didn't just return 12%. It ran closer to 22% annually. Now watch what happens when you plug that figure into a calculator and let greed take the wheel. $10,000 compounding at 22% a year for 30 years doesn't just turn into a comfortable retirement, it balloons into something absurd. $3.7 million from a $10,000 start. You can understand why someone sees that math once and dumps their entire savings into a single tech fund. That number is intoxicating, and it's a trap. Not because the arithmetic is wrong, but because no fund on the planet sustains 22% growth for 3 decades straight. That figure is a recent hot streak, not a fixed law of nature. Rewind to a similar tech-heavy fund during the dot-com collapse, and the NASDAQ lost more than 80% of its value, then took over 15 years just to crawl back to break even. 15 years, not to get rich, just to get back to zero gain. So that seductive $3.7 million version of Jordan's story is fantasy math. Gorgeous on paper until you remember paper has never once survived an actual decade intact. The real math is far quieter, and it's coming for all 3 of them at once. Using those tempered assumptions, by year 10 the 3 have drifted apart, though not dramatically. The market sits around $26,000, the bet leads at roughly $31,000, and the paycheck trails around $24,000. If you've lost track of the details, here's all you need going forward. Jordan is winning, and everyone assumes that's permanent. Then the market does what markets have always eventually done. It drops. This is the part no projection chart will ever capture because it isn't a number, it's a gut punch. Picture Jordan's position sitting at $30,000 when an ordinary tech correction, the kind that's happened repeatedly throughout history, knocks it down about 35%. That $30,000 becomes $19,500 within weeks. Over $10,000 vanishes on a screen in roughly the time it takes to develop a compulsive habit of refreshing an app. And here's the small detail almost nobody clocks in that exact moment. While Jordan's account is bleeding red, Ben's dividend still arrives right on schedule. Same modest 3-figure deposit as always. The whole market is on fire, and the paycheck guy just got paid anyway. He barely glances up. Now comes the test that actually determines everything, and it has almost nothing to do with which fund you picked. Does Jordan hold on? On paper, if Jordan simply sits tight, the fund recovers and the story continues. But Jordan spent 3 years telling everyone about that $72,000 figure. Jordan's whole identity became up 11% this quarter. Watching that identity shrink by a third overnight isn't a spreadsheet moment, it's a 3 a.m. moment. And most people, when they hit that 3 a.m. moment, do the exact thing that converts a temporary loss into a permanent one. They sell. This is the quiet twist buried inside every video like this one. You've been sitting here comparing 3 funds as if the fund itself decides how much money you end up with. Mostly it doesn't. You do. There's an annual study called Mind the Gap that measures something genuinely harsh. It compares what funds actually return against what the people invested in them actually pocketed. Over the decade ending in 2024, the average investor lagged their own funds by about 1.2% a year, giving up roughly 15% of their potential gains. Not because they chose bad funds, but because they got fearful near the bottom and greedy near the top and traded on those emotions. And the wilder the fund, the bigger that gap grows. Calm, steady funds cost people around 0.8%. The exciting, volatile ones, the bet-shaped funds, cost nearly double that. Let's attach a real dollar figure to it. That 1.2 to 2% gap, compounded over 30 years on a $10,000 investment, quietly cost you around $49,000. $49,000 not lost to a crash, not lost to fees, but lost to the very human act of flinching at exactly the wrong moment. Some researchers argue that gap shrinks once you factor in how people contribute money gradually over time. And that's a fair point. But even the smaller version of that gap points in the same direction. The account leaks most through the hole labeled "you." So far, I've mostly picked on Jordan, and if I stopped here, I'd just be doing what every tech fund influencer does, only in reverse. So let me turn the blade around and be fair to all three, because each of these funds hides a real weakness nobody's fan club ever mentions. Start with the market, Maya's safe choice. The S&P 500 sounds like total diversification. 500 companies, the whole economy. What could possibly go wrong? But look closer, and it's nowhere near as spread out as it appears. A huge portion of Maya's money rides on the very same handful of giant tech names dominating Jordan's fund. Maya believes she sidestepped the tech bet entirely. In reality, she just took a smaller version of the same bet while feeling cautious about it. And that's the most dangerous kind of risk there is, the kind you're convinced you don't have. Now the bet. We've hammered on the volatility, but the deeper issue is what that volatility does to a normal human nervous system. A fund that can drop 35% is only a great choice for the rare person who can watch a third of their money disappear and feel absolutely nothing. Most people aren't wired that way, and they find out exactly which kind of person they are at the worst possible moment. And the paycheck, the dividend strategy everyone does through, its weakness runs the opposite direction. Over these 10 years, it simply earned less than the other two, because Ben skipped the growth rocket entirely. He traded upside for steadiness and income. That's a real cost. Safety is never free, it just sends you the bill later, in a currency called the gains you never got to keep. Underneath all three sits a truth the thumbnails conveniently ignore. Over nearly a century, the American stock market has averaged close to 10% annually. But strip out inflation, and the real number, measured in actual purchasing power, drops closer to 7%. Inflation is the silent partner riding along in every one of these accounts. Nobody invited it, it never says thanks, and it quietly skims its cut from all three portfolios every single year. And a substantial chunk of even that 7%, nearly 40% over the long run, came not from rising stock prices but from dividends being reinvested. The exact unglamorous thing Ben has been doing this whole time while nobody applauded. Fees matter here too, in the same understated way. The market's $3 fee and the bet's $18 fee sound almost identical. Stretch that gap across 30 years though, and Jordan hands over roughly $7,000 more than Maya purely in costs. And if any of them had accidentally landed in a typical 1% fee fund instead of these cheap ones, that single careless choice would have cost around $40,000 over the same stretch. The fee you barely notice is almost always the one doing the most damage. So let's finally deliver on the promise from the opening and run the full 30 years, assuming all three genuinely hold on, which, as we've now established, is a fairly heroic assumption. Here's roughly where each of them lands. At 20 years, the market has grown to about $67,000. The bet at that hotter 12% sits near $96,000, and the paycheck reaches around $56,000, plus every dividend Ben has quietly pocketed along the way. Stretch it to a full 30 years, and the numbers turn almost cartoonish. The market lands near $174,000, the bet climbs toward $300,000, and the paycheck settles around $133,000. And I know exactly what that table looks like. It looks like Jordan just won outright, and we all spent 20 minutes getting here for nothing. But look closely at what that giant number silently assumes. It assumes Jordan held through every single crash without ever flinching. It assumes Jordan never sold in a panic, never chased something hotter, never let one of those 35% drops quietly turn permanent. On a spreadsheet, the bet wins by a landslide. In an actual human life, it's the least likely of the three to survive contact with reality, because a spreadsheet doesn't have a nervous system. You do. So who really wins? The honest answer is that it depends entirely on who you are, and I mean that as genuine advice, not a dodge to avoid picking a side. If you're just getting started with decades stretching ahead of you, and you want one single fund you never have to think about again, the market is remarkably hard to beat. Cheap, broad, proven, and boring in exactly the way that quietly builds wealth. If you've got a genuinely long time horizon, a steel stomach, and can honestly promise yourself you won't touch the app during a crash, the bet has historically rewarded that kind of discipline enormously. That tech tilt is precisely what drove those massive numbers for the small handful of people who could actually leave it untouched and let it run. And if you're closer to needing the money, or you simply sleep better seeing real cash hit your account, the paycheck does something the other two structurally can't. It pays you while you wait, and that income softens the blow when everything else drops. Remember Ben's modest $330. Under these same assumptions, that payout grows to roughly $2,000 a year by year 20, arriving whether the market is up, down, or completely on fire. But here's the twist this whole video has been building toward, that fourth option I asked you to keep in mind. There was never a rule saying you had to choose just one. The fourth path was splitting that $10,000 across all three. A slice of the market, a slice of the bet, a slice of the paycheck, then doing the single hardest thing in all of investing? Nothing. Track that blended combination over the last decade, and it delivered a genuinely solid return. But the real story isn't the return, it's that the mix fell far less hard than the bet did on its own. When the crash hit, the paycheck kept arriving, the market held things steady in the middle, and the whole portfolio dropped noticeably less, meaning you'd have been far less tempted to bail out at the bottom. That's the version that actually wins, not because it hunted down the single best fund, but because it built something an ordinary, nervous human being could realistically survive owning through the worst week of their financial life. And that's the entire game. The real trap was never VOO versus QQ versus SCHD. The real trap is choosing any single one of them because a confident stranger online, a 5-second clip, or something your cousin swore by at a family dinner told you to, and then bailing the moment it actually starts to hurt. So, the next time someone insists they've found the single best index fund, don't argue with them about the fund itself. Ask 2 questions instead. First, what does this actually return after fees, after inflation, and after an actual nervous human gets their hands on it? And second, the question that matters more than any chart ever will. When this thing eventually drops 35%, and at some point it absolutely will, are you going to hold, or are you going to become the reason your own investment failed? Because Maya, Jordan, and Ben all put in the same $10,000 on the same ordinary afternoon. 30 years from now, the gap between them will have almost nothing to do with the 3 letters they typed, and almost everything to do with what each of them did on their worst day. Pick the fund you want. Then make absolutely sure you've picked a plan you can actually survive.